Hello, I'm Emily Costa, and welcome to the Commodities Institute podcast. Today is November 28th, 2025. Over the next 20 minutes, I'm going to walk you through the stories that matter across oil, metals, carbon and power, and agriculture, and explain why they should be on the radar of every trader, producer, and policymaker. I'll keep it conversational and I'll slow the pace so the big ideas land clearly. Let's start in oil, because supply policy at the top of the market still sets the tone for everything else. OPEC Plus is expected to hold output policy steady for the first quarter of next year. That matters because the group controls roughly half of global crude production. The smaller cohort of 8 members who have been incrementally raising output this year, Saudi Arabia, Russia, the United Arab Emirates, Kazakhstan, Kuwait, Iraq, Algeria and Oman, agreed earlier to pause further hikes in the first quarter of next year, and that pause looks likely to stick. At the same time, ministers are talking about a technical but consequential change, agreeing on a mechanism to assess members' maximum production capacity. On its face, that sounds bureaucratic, but this type of capacity assessment becomes the yardstick for baseline output allocations and ultimately the size of any future cuts. Baseline arithmetic has real winners and losers. We've already seen Angola walk away from the group when it disagreed about its assigned level. The takeaway for listeners is this: stability in policy for the near term, plus the establishment of a capacity framework, means markets will likely see a measured approach to supply next year rather than a dramatic swing. Staying in oil, but shifting to corporate strategy, Brazil's state oil company has just released a new 5-year plan that lowers total investment expectations and trims dividend forecasts. Petrobras now expects to distribute between $45 and $50 billion in ordinary dividends across the planning period and to invest roughly $109 billion, down from prior plans. The company is, however, increasing investment in exploration and production, a sign that while macro price pressures are causing a conservative posture, management still prioritizes upstream growth. Petrobras also projects a peak oil production rate within the planned timeframe, which is a nod to its ambitions, but also a reminder that planned production targets are sensitive to global prices and local politics. Let's pivot to metals, where the market is navigating both overcapacity concerns and feedstock tightness. China has announced it is shelving about 2 million metric tons of planned new copper smelting capacity. That's big in headline terms, but analysts at a recent conference cautioned that projects already under construction will still come online, so the immediate market impact could be limited. What's more relevant is the broader policy shift. Beijing is showing signs of dealing with rampant industrial overcapacity across coal, lithium, and other raw materials. If this is the start of a more forceful campaign, think forced closures or production caps, then we could see a structural change in refined metal markets that tightens concentrate availability and pushes treatment and refining charges higher. Right now, those fees are at historically low or even negative levels in places, reflecting a mismatch between smelting growth and concentrate supply. Meanwhile, in Japan, smelters are trying to negotiate treatment and refining charges for next year at levels different from China-set benchmarks, aiming to secure better terms. That divergence could create regional spreads in refining economics and influence where concentrates flow. The carbon and power story is becoming a seasonal risk, particularly in China. Authorities are bracing for record winter peaks in both electricity load and daily gas consumption. A longer than usual heating season combined with cold snaps could push coal consumption higher than last year. The country reports substantial coal inventories at power plants, 230 million tonnes, which industry officials say is enough for about 35 days. And regulators have been improving inter-regional transmission to manage spikes. For commodity players, that means tighter thermal coal demand over the winter, potential pressure on gas balance, and a watchful eye on power dispatching that could affect metals smelting and industrial output. Now to agriculture, where Brazil continues to be the dominant story. Agroconsult's first forecast for the 2025-26 season sees Brazilian soybean production reaching a record 178.1 million metric tons, driven by a modest expansion in planted area and conversion of pasture to cropland. Most of that new crop is already in the ground, with some shipments expected as early as January. China remains the big buyer, and abundant Brazilian supplies underpin forecasts for exports rising further. But there's a wrinkle. Chinese authorities have notified Brazil that 5 export facilities are temporarily banned for shipments after an incident involving wheat treated with pesticides found aboard a vessel. That intervention affects only a handful of plants relative to the thousands authorized to ship to China, but it's a reminder that sanitary and phytosanitary risks can disrupt flows quickly, especially when markets are already long. Across the Atlantic, Brussels nudged up its estimates for EU soft wheat and maize production for the season, which in turn lifted projected ending stocks modestly. That's a calming factor for markets that had worried about tight global grain supply this year. And in North Africa, Tunisia reportedly bought roughly 75,000 metric tons of feed barley in a tender seeking up to 125,000 tons, a signal of tightness and strong demand for animal feed in the region. European feed barley prices are surprisingly firm, sometimes matching milling wheat, which is unusual and points to a tightness in certain corridors. Before we close, a quick freight and infrastructure note that ties to all this. Alberta and Canada are negotiating an energy deal that rolls back an emissions cap on oil and gas in exchange for stronger industrial carbon pricing and support for carbon capture and storage projects. The federal government is also pushing to enable pipeline development toward the Pacific to reach Asian markets. That's geopolitical and logistical leverage. If a new route materializes, Canadian crude flows and global shipping patterns shift, with knock-on effects for freight markets and refinery runs. So where does this leave us? The near-term picture is one of policy stability in oil, cautious corporate recalibration at major producers, potential structural changes in global metals refining capacity if China follows through, and abundant Brazilian agricultural supplies that are nevertheless vulnerable to localized trade frictions. For traders, that means watching the capacity assessments that come out of OPEC+, monitoring Chinese industrial policy for any escalation on smelting and output controls, and keeping an eye on sanitary notifications that can interrupt grain flows at short notice. That's it for today's episode of the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review.